You know that feeling when you look at the stock market and it just seems designed to be confusing? Yeah, you are not alone. Today, we're going to cut through all that noise with Pat Dorsey's 5 rules for successful stock investing. Think of it as a clear, simple framework for what actually matters when you're trying to build long-term wealth.
And this quote right here, it just nails it. It really sets the stage for everything we're about to cover. The principles here aren't some kind of complex financial wizardry. Nope. Their real power comes from discipline and from patience, which, let's be real, is often the hardest part of all.
Because let's be honest, watching those tickers flash red and green all day, hearing analysts shouting about upgrades and downgrades, it often feels way more like a high-stakes casino than a place for serious investing, doesn't it? The whole system is kind of designed to make you trade, not to actually invest.
So that brings us to the big question. If we want to get out of that casino mindset, what's the alternative? How do we stop gambling on these little price swings and start actually investing in our future? Well, it all starts with having a solid framework. And this is that framework. Dorsey lays out 5 super clear, actionable rules that basically act as your roadmap. These aren't just little tips and tricks, they make up a complete investment philosophy, and we're going to walk through it right now.
Okay, so these are the 5 pillars. It all kicks off with doing your research. Then, you find companies that have a real, durable advantage. You buy them at a smart price, you hang on for the ride, and then finally, you know the right reasons to actually let go. We're going to dive into what makes each of these so powerful, starting with this idea of an economic moat. Let's start with my absolute favorite concept here, the economic moat. Seriously, think of a medieval castle. What kept it safe from invaders? A big, wide moat. Well, in the business world, that moat is a sustainable competitive advantage. It's the thing that lets a great company fight off its rivals and protect its profits year after year. This could be a super powerful brand, a really low-cost way of making things, or even just high switching costs that basically lock customers in. So here's the crucial part. Finding a great company isn't quite enough. You have to buy it at a great price. And that's where this margin of safety comes into play. You do the work to figure out what a business is truly worth, its intrinsic value. And then you only pull the trigger when the market price is way below that. That gap, that's your cushion. That's what protects you if you made a mistake or if things just go unexpectedly sideways.
Now check this out. This slide perfectly illustrates rule number 4, hold for the long haul. So meet Trader Tim and Long-Term Lucy. They both start with 10 grand, and they both earn the same 9% return every year. But Tim, he trades his entire portfolio twice a year, racking up all these commissions and paying high taxes. Lucy, on the other hand, she holds her stocks for 5 years at a time. So after 30 years, Tim's impatience leaves him with just under $31,000. And Lucy's patience? Her portfolio is worth over $92,000. That difference is the staggering cost of trading too much.
But, following the rules is really only half the battle. The other half is knowing what not to do. As you're about to see, just avoiding the big mistakes is often way more profitable than picking a few big winners.
Dorsey lays out these 7 traps that can absolutely sink your portfolio. And let's be honest, we've all been tempted by at least one of these. First, you've got swinging for the fences. That urge to bet it all on some risky stock, hoping for a home run. It almost never works. Then there's falling in love with a product. Just because you love your new phone doesn't mean the company is a great investment. Remember the Palm Pilot? Awesome product, but the business itself had terrible margins and a ton of competition. And another big one is trying to time the market, jumping in and out based on gut feelings. It's a game that even the pros almost never win.
And this quote, wow, it just brilliantly illustrates that second trap we just mentioned. Every single market bubble in history has been fueled by this exact belief. Look, history rhymes. The basic principles of economics don't just vanish. Remembering this can save you from a world of hurt.
So when you combine those 5 rules with an awareness of these 7 traps, it leads to this really profound shift in your mindset. And this, right here, is the ultimate takeaway from this whole philosophy.
And it's this. When you buy a stock, you're not buying a lottery ticket that just blinks up and down on a screen. You are buying a small piece of a real business. Your goal should be to find wonderful businesses and buy them at reasonable prices. The stock price, eventually, will follow the value of the business.
This slide just lays out the 2 paths so clearly. The investor acts like a business owner. They're focused on the company's financials, its competitive advantages, the long haul.
The trader, well, they act more like a bettor at the casino, trying to guess short-term price moves based on charts and noise. The 5 rules are designed to put you firmly and successfully in the investor's camp.
So as we wrap up, this is the question I want you to ask yourself. Is your process focused on really understanding the long-term value of a business, or are you getting caught up in the daily drama of the price charts? Your answer to that question will probably determine your success in the market.